In 1998, a hedge fund called Long-Term Capital Management nearly destroyed the global financial system. This wasn't a typical hedge fund. It was run by some of the smartest people on the planet. 2 Nobel Prize-winning economists. Former vice chairman of the Federal Reserve. Star traders from Salomon Brothers who had made billions on Wall Street. They had built mathematical models so sophisticated that other investors couldn't even understand them. And for 4 years, it worked. Returns averaged over 40% annually. They made money in ways that seemed impossible. They found tiny price inefficiencies in bond markets and exploited them with massive leverage. It was mathematical arbitrage, essentially risk-free profit extracted through genius and computers. Until it wasn't. In September 1998, Long-Term Capital Management had positions worth over $1 trillion. $1 trillion. With only $4 billion in actual capital. That's leverage of over 250 to 1. When their models broke, when the assumptions failed, the entire fund imploded in weeks. The Federal Reserve had to organize an emergency $3.6 billion bailout from 14 major banks because letting LTCM fail would have triggered a cascade that could have brought down the entire financial system. This wasn't some reckless gambler making stupid bets. This was mathematical genius combined with Nobel Prize-winning theory failing catastrophically because the models couldn't account for human behavior during panic. But here's what matters right now in December 2024. The same pattern is forming again, except the scale is far larger and the danger is far greater. Quantitative hedge funds using artificial intelligence and machine learning now manage over $1.5 trillion. Cryptocurrency derivatives markets have exploded to over $3 trillion in notional exposure. Leverage across the financial system has reached levels that make 1998 look conservative. And most terrifying, the mathematical models being used today are so complex that even the people building them don't fully understand how they'll behave during extreme stress. We've replaced human genius with artificial intelligence, but we've kept the same fatal assumption that models can predict and control markets. Based on every pattern from LTCM and every current market structure analysis, we're approaching a moment in late 2025 or 2026 when multiple quantitative funds will blow up simultaneously, triggering contagion that makes 1998 look like a practice round. The infrastructure is already built. The leverage is already deployed. The models are already running. The only question is what breaks them and whether you're positioned to survive and profit when genius fails again. Because in 1998, investors who understood that the collapse was about model failure not fundamental economics bought quality assets during the panic and made extraordinary returns over the following decade. Long-Term Capital Management was founded in 1994 by John Meriwether, a legendary bond trader from Salomon Brothers. Meriwether had built Salomon's arbitrage group into one of the most profitable operations on Wall Street during the 1980s. He understood something that most traders didn't. Financial markets aren't perfectly efficient. There are tiny pricing discrepancies that exist for brief moments. If you can identify those discrepancies and exploit them with enough capital and leverage, you can extract consistent profits with supposedly minimal risk. It's called convergence arbitrage. You find 2 similar bonds that should trade at nearly identical prices but don't. You buy the cheap one, sell the expensive one, and wait for the prices to converge. The profit on each trade is tiny, maybe a fraction of a percent. But if you do it thousands of times with massive leverage, those tiny profits become enormous. To execute this strategy at scale, Meriwether needed the smartest people he could find. He recruited Myron Scholes and Robert Merton, who would win the Nobel Prize in Economics in 1997 for their work on options pricing models. He brought in David Mullins, who had been vice chairman of the Federal Reserve Board. He assembled a team of PhDs in mathematics, physics, and economics. These weren't traders in the traditional sense. They were academics who believed that markets could be understood, modeled, and exploited through mathematical precision. And they had something to prove. That genius and quantitative analysis could beat the market consistently. That they had found a way to make money that was as close to risk-free as possible in finance. The early results seemed to confirm their brilliance. In 1994, LTCM returned 28% after fees. In 1995, 59%. In 1996, 57%. These weren't normal hedge fund returns. These were systematic money-printing returns with supposedly low risk. The fund's assets under management grew from $1 billion to $7 billion. Banks were desperate to lend to them because LTCM's reputation and track record seemed unassailable. Who wouldn't lend to Nobel Prize winners with perfect models? The leverage kept increasing. By 1998, LTCM had $4.7 billion in capital but controlled positions worth over $125 billion. And when you included all the derivatives exposure, the notional value exceeded $1 trillion. They had borrowed so much money that the positions couldn't be unwound without moving markets. The strategy seemed elegant and safe. LTCM focused on convergence trades where historical relationships between assets had temporarily diverged. For example, if US Treasury bonds and similar German bonds normally traded with a certain spread, but that spread had widened, LTCM would bet that it would narrow back to historical norms. These bets weren't about predicting the future. They were about mean reversion, the idea that relationships that had held for decades would continue to hold. The models were based on sophisticated mathematics, incorporating probabilities and correlations calculated from years of historical data. According to their models, the risk of catastrophic loss was infinitesimally small. So small that it essentially couldn't happen. Except it did happen. And when it happened fast. In August 1998, Russia defaulted on its government debt. This wasn't supposed to matter much to LTCM. Their positions were mostly in developed market bonds, US and European government debt. Russian bonds were a tiny part of the portfolio. But the default triggered something the models hadn't anticipated. A global flight to quality. Investors everywhere started selling anything risky and buying the safest assets possible, primarily US Treasury bonds. This caused spreads to widen dramatically. All the relationships that LTCM had bet would converge started diverging instead. Violently. When you're leveraged 250 to 1, even small moves against you become catastrophic. LTCM's model said these moves were impossible, that the statistical probability was so low it shouldn't happen in the lifetime of the universe. But markets don't care about statistical models during panic. The firm started losing hundreds of millions of dollars per day. Their equity capital, which had been $4.7 billion at the start of the year, fell below $1 billion by September. And they couldn't close their positions. They were too large. Trying to unwind would move markets even more against them. They were trapped in positions that were bleeding them to death. The partners at LTCM kept believing their models were right and the market was wrong. They thought this was a temporary panic that would reverse. They even tried to raise more capital to ride it out, to wait for the convergence that their mathematics said was inevitable. But other traders had figured out what positions LTCM held. When you're that big and that leveraged, your positions become known. And once other traders knew, they started betting against LTCM, pushing prices even further from where the models said they should be. It became a self-fulfilling prophecy of destruction. By mid-September, LTCM's capital had fallen to $600 million while they still controlled over $100 billion in positions. The leverage ratio had exploded past 150 to 1. Banks that had lent to them started panicking. If LTCM defaulted, the banks would have to liquidate the collateral, dumping massive positions into already chaotic markets. The unwinding would trigger more selling, more losses, more margin calls across the entire system. It wasn't just LTCM that would fail. It was the possibility that their failure would cascade through every major financial institution that had exposure. That's when the Federal Reserve stepped in. Not with government money, but with organization and pressure. Fed officials brought together the heads of 14 major banks and Wall Street firms. The message was clear. If you don't bail out LTCM, the contagion will hit you all. Each firm contributed to a $3.6 billion rescue fund that recapitalized LTCM and gave the consortium control of the firm. It wasn't a bailout in the traditional sense. It was forced cooperation to prevent systemic collapse. The private sector saved itself, but only because the Fed forced them to recognize that they all had skin in the game. LTCM was wound down over the following months. The positions were carefully unwound to avoid triggering further market chaos. The partners who had been paper billionaires months earlier lost essentially everything except what they had already taken out. The banks that participated in the rescue eventually made money back as positions normalized. And the financial system survived. But the lesson should have changed everything. It didn't. What LTCM should have taught was that mathematical models, no matter how sophisticated, cannot fully capture the behavior of markets during extreme stress. That leverage turned small risks into existential threats. That genius is not a substitute for humility. That when everyone is using similar models and similar strategies, the diversification is an illusion because everyone will try to exit at the same time. And most importantly, that the complexity of modern financial markets had reached a point where failures in one place could cascade globally faster than anyone could react. Instead, what actually happened was that the financial industry concluded that LTCM had just been unlucky. That their models were basically correct, but they'd hit a black swan event, an unpredictable outlier. The solution wasn't to reduce leverage or simplify strategies. It was to build even more sophisticated models that could supposedly predict black swans. Risk management became more mathematical, not less. Leverage continued to grow. And the belief that markets could be tamed through quantitative analysis became even more entrenched. Now here's where this becomes critical for you right now. Everything that made LTCM dangerous exists today in far more extreme forms. Quantitative hedge funds using artificial intelligence and machine learning manage over $1.5 trillion as of 2024. These aren't funds run by humans making judgments. They're algorithms identifying patterns, calculating probabilities, and executing trades at speeds and scales that dwarf what LTCM could do in 1998. The models are far more complex. They process millions of data points per second. They adapt in real time. And almost nobody, including the people who built them, fully understands how they'll behave when markets break their normal patterns. Leverage across the system has reached levels that make 1998 look quaint. Cryptocurrency derivatives markets have exploded to over $3 trillion in notional exposure. This is LTCM multiplied by 3, operating in markets that are far less liquid and far more volatile than government bonds. Crypto funds routinely use leverage of 50 to 1 or higher. When the positions move against them, liquidations cascade in minutes, not days. We saw this in miniature in 2022 when FTX collapsed. Sam Bankman-Fried was called a genius. He had sophisticated risk models. He had billions in backing. And his entire empire imploded in 72 hours when the models failed to account for customer panic and interconnected leverage. The parallels to LTCM are obvious if you're paying attention. Genius reputation? Check. Mathematical models claiming to manage risk? Check. Massive leverage? Check. Overconfidence that this time is different because the math is better? Check. And the outcome will be the same. When the models break, when some event happens that the algorithms didn't train on or can't process correctly, the unwinding will be fast and brutal. Except this time it won't be one fund with $1 trillion in exposure. It will be dozens of quantitative funds, crypto derivatives platforms, and algorithmic trading systems all trying to exit similar positions simultaneously. The data showing current fragility should be alarming to anyone paying attention. Correlation between assets has been increasing, meaning more things move together, which means diversification is an illusion, and when selling starts it hits everything. Quantitative funds are crowding into similar trades because their algorithms identify similar opportunities. This creates herding behavior that is invisible until it triggers all at once. Liquidity in many markets has decreased despite higher trading volume because most of that volume is algorithms trading with each other, and when stress hits, those algorithms withdraw instantly. Cryptocurrency markets show this fragility most clearly. In May 2021, Bitcoin fell 30% in a single day as leveraged positions liquidated in cascade. In November 2022, FTX collapsed from $32 billion in valuation to bankruptcy in 3 days. In March 2023, several stablecoins broke their pegs as algorithmic arbitrage failed. These aren't isolated incidents. These are warnings that highly leveraged, model-driven markets are inherently unstable during stress. And the exposure is only growing. Bitcoin ETFs launched in 2024 are bringing institutional leverage into crypto. Pension funds and endowments are allocating to quantitative strategies. The interconnections between traditional finance and crypto derivatives are deepening every month. Now let's map the timeline based on every LTCM pattern and every current stress indicator. Right now through the second quarter of 2025, we're in the confidence phase. Quantitative funds are generating strong returns. AI is delivering on promises in some areas. Markets are functioning normally. Leverage is building but seems manageable because volatility is low. This is exactly how 1996 and 1997 looked for LTCM. Strong performance, growing assets, increasing leverage, no obvious problems. The third quarter of 2025 through the first quarter of 2026 is when the structure likely breaks. Some external shock, it could be geopolitical, a sovereign debt crisis, a major corporate bankruptcy, a crypto exchange failure, triggers enough selling to activate the cascade. Quantitative models will start registering unusual market behavior. Risk management systems will begin reducing exposure. That selling will push prices further from normal. More algorithms will trigger. More funds will try to exit. The correlations that models assumed were stable will break. Positions that seemed diversified will all lose simultaneously. The unwinding will be faster than 1998 because everything operates at algorithmic speed now. LTCM took weeks to fail. Modern quantitative funds could fail in days or hours as algorithms execute their risk management protocols. The leverage is higher. The positions are larger. The interconnections are tighter. And unlike 1998, there are multiple LTCMs operating simultaneously. The Federal Reserve can force banks to bail out one fund. They can't force bailouts of dozens of algorithmic strategies failing at once. The second quarter of 2026 through year-end is the recovery positioning phase. After the acute crisis, after the forced liquidations and emergency interventions, markets will stabilize. The Fed will cut rates. Governments will announce support programs. And just like after LTCM, the fundamental economy will still be functioning. The companies that were worth X before the crisis will still be worth X after. But in the interim they'll have traded at 50 or 60% of X because algorithms temporarily broke the pricing mechanism. So what do you do? Here's exactly how you position before genius fails again. Step 1 is building a 45 to 55% cash position by the third quarter of 2025. This seems insane when markets are working and quantitative funds are printing money. But you're not trying to maximize returns in the final phase of the cycle. You're positioning for the event. Use Treasury money market funds or short-term Treasury bills. Maximum safety and instant liquidity. When the models break and algorithms cascade, this cash becomes your capital to buy quality assets at panic prices. Step 2 is understanding which markets will be most affected. LTCM was primarily in government bonds. The next crisis will likely center on cryptocurrency derivatives and quantitative equity strategies. This means crypto will see liquidation cascades that make 2022 look mild. Leveraged long positions in AI stocks and tech will unwind violently. Algorithmic trading strategies in equity markets will all try to reduce exposure simultaneously. But traditional safe havens, high-quality bonds, essential industry stocks, will also get sold because algorithms don't discriminate during deleveraging. Everything correlated sells together. That's your opportunity. Step 3 is building a watch list of quality companies that will be unfairly punished during algorithmic panic. The machines don't analyze business fundamentals during risk-off mode. They just execute. Find 20 to 30 companies with zero or minimal debt, strong free cash flow, essential products or services that maintain demand through cycles, and global revenue diversification. Healthcare companies with recurring pharmaceutical revenue. Utility companies that provide electricity regardless of market sentiment. Consumer staple companies that sell products people buy in good times and bad. Energy companies benefiting from long-term supply-demand dynamics. These will be sold with everything else when algorithms panic. That's when you buy them. Step 4 is recognizing that trying to trade around the crisis will fail. You cannot predict the exact trigger or time the exact bottom. The algorithms operate faster than you can perceive. By the time you realize the cascade has started, prices will have already moved. Your strategy has to be positioned before the event and deployed during the panic in stages. When markets are down 20% from recent highs, deploy 10% of your cash into your quality watch list. Down 30%, deploy another 15%. Down 40%, deploy another 15%. This ensures you're buying progressively cheaper while maintaining reserves if the decline goes further. Step 5 is understanding that most investors will do the opposite of what works. When quantitative funds start failing, financial media will interview the geniuses explaining why their models are correct and markets are wrong. Retail investors will believe them because these are smart people with credentials. When the cascade accelerates, panic will drive most people to sell everything to preserve what they have left. The instinct to join the herd during crisis is overwhelming. You need to have trained yourself in advance that algorithmic cascade creates temporary mispricing, not permanent value destruction. Here are the specific signals to watch that will tell you genius is about to fail again. Signal 1 is quantitative fund performance divergence. These funds typically move together because they use similar models. When you start seeing some quant funds posting unusual losses while others are still positive, it means some strategies are breaking. This typically precedes broader failure by 30 to 60 days. Trade publications and hedge fund databases track this. Start monitoring quarterly. Signal 2 is crypto leverage metrics. Platforms like CoinGlass track total leverage in cryptocurrency derivatives markets. When open interest in futures and perpetual swaps exceeds 200 billion with funding rates suggesting extreme leverage to the long side, the setup for cascading liquidations is complete. A 10% decline can trigger automatic liquidations that force a 20% decline that triggers more liquidations. This is visible in real-time data. Watch it daily starting mid-2025. Signal 3 is correlation spikes in equity markets. During normal times, stocks move somewhat independently based on company-specific factors. As algorithmic trading dominates and quantitative strategies converge, correlation increases. When the average 30-day correlation between S&P 500 stocks exceeds 0.75, it means fundamentals have been overridden by systematic flows. Markets are fragile. Use free tools like Portfolio Visualizer to track this monthly. Signal 4 is liquidity withdrawal in credit markets. LTCM failed because they couldn't exit positions without moving markets against themselves. The modern equivalent is watching bid-ask spreads in corporate bonds and credit default swaps. When spreads widen significantly, above 500 basis points for high-yield debt, while equity markets are still calm, it means institutional investors are preparing for stress. This precedes equity market cascades by weeks. Bloomberg and Fred economic data track this. Signal 5 is emergency meetings and regulatory warnings. Just like 1998, when the crisis gets serious, regulators start having closed-door meetings with major financial institutions. The Fed, SEC, and CFTC will issue statements about monitoring market conditions. These are signals that authorities see something breaking. By the time these are public, you should already be positioned, but they confirm the cascade is approaching. Your 90-day action plan starting right now must be specific and measurable. In the next 30 days through January 2025, audit your current portfolio. Calculate exact exposure to quantitative strategies, crypto, leveraged positions, and AI-heavy tech stocks. Most people have no idea how much exposure they have to algorithmic strategies through index funds and ETFs. Get precise. Open Treasury money market accounts if you don't have them. Begin moving 15% of your portfolio to cash. Start building your quality company watch list. In the 60-day window through February 2025, increase cash allocation to 30%. This means selling positions. It might mean taking profits on AI stocks that have run up. It might mean accepting small losses on positions that haven't worked. You're repositioning for an event, not optimizing for the current environment. Set up monitoring for the 5 cascade signals. Create a simple tracking system that updates weekly. Familiarize yourself with how to execute trades quickly during chaos. In the 90-day window through March 2025, reach 45 to 50% cash allocation. Finalize your watch list with specific price targets for each company, typically 30 to 50% below current levels. This seems absurd now but won't during the cascade. Run psychological preparation scenarios. Visualize markets falling 30% and you deploying capital while everyone else panics. Mental preparation matters as much as financial preparation because your instincts will scream at you to sell when you should be buying. The parallels between LTCM 1998 and today aren't subtle. In 1998, the smartest people in finance built models they believed were perfect. In 2024, we've automated that overconfidence and given it to artificial intelligence. In 1998, leverage was 250 to 1 in a single fund. In 2024, leverage is comparable or higher across dozens of quantitative funds and crypto platforms. In 1998, the failure took weeks. In 2024, algorithmic execution means the cascade will take days or hours. In 1998, the Federal Reserve could organize a private sector bailout. In 2024, the scale and speed might exceed the ability to coordinate rescue. But there's one crucial difference that creates opportunity. In 1998, the failure of LTCM didn't mean the bonds they held were worthless. It meant genius had overestimated their ability to predict and control markets. The positions eventually converged to profitable levels after the leverage was removed. The investors who bought distressed assets during the crisis made money not because they were smarter than the Nobel Prize winners, but because they understood that model failure isn't the same as fundamental value destruction. In 2026, when quantitative funds and algorithmic strategies fail, it won't mean the quality companies they're forced to sell are worthless. It will mean models broke. Artificial intelligence encountered scenarios it wasn't trained on. Leverage turned manageable risk into existential crisis. And just like 1998, the recovery will reward those who had capital to deploy when genius failed. Long-term capital management taught us that brilliant people with perfect-seeming models can be catastrophically wrong. That leverage amplifies genius during good times and destroys it during stress. That mathematical sophistication is not a substitute for humility about what can't be modeled. And that when genius fails at scale, the system scrambles to rescue itself while ordinary people pay the price. Today's artificial intelligence-driven quantitative strategies are LTCM multiplied by dozens of funds with far more leverage operating at algorithmic speed in markets that are less liquid and more fragile. The genius that nearly ended the world in 1998 is back, except now it's artificial and operating faster than human perception. The mathematical models are more complex. The leverage is higher. The interconnections are tighter. And the next failure won't require Fed intervention because it will be over before regulators can convene meetings. History doesn't repeat, but the patterns are unmistakable. Genius plus leverage plus overconfidence equals catastrophic failure when models meet reality. LTCM proved this in 1998. The next generation of quantitative funds will prove it again in 2026. The only question is whether you'll be positioned to profit from the genius failure or be destroyed alongside it. If this gave you the exact playbook to position before artificial intelligence and quantitative models fail catastrophically in 2026, hit subscribe. The algorithms are getting smarter. But smart doesn't mean right. And when they're wrong, fortunes will transfer from those who believed in the models to those who understood their limits.